Welcome back. My name is Kura, Chihota, and this is Smart Money. I'm in studio with Warren Ingram, and if you've just tuned in, we're talking about multi-asset investing. Today, we're joined in studio by Craig Gradidge, and who is an investment specialist at Gradidge-Mahura Investments. Welcome to you, Craig.
Yes, good evening, Kura and Warren.
It's always good, you know, in the world we have the Alan Grays and the human beings who've done stuff. It's good to see my ex-Vitsi name a brand and operating. Fantastic stuff.
Thank you.
Multi-asset investing. Please help me. Warren was tripping over himself trying to explain it, but you know,
now we've got the guru.
He's a bit slow. Forgive him.
No, sure. Yeah, so multi-asset investing, as Warren correctly put it earlier,
Sorry, did you hear that correctly?
1 point to Warren.
It's building a portfolio comprising of a combination of asset classes: equities, bonds, cash, property, local and offshore. And the trick is to get that mix of assets right, so that you're able to increase the probability that you'll achieve your investment objectives, whatever those objectives are.
Probability. You say he's going to speak plain and simple English to me. Dude, I was terrible at statistics. So probability means I'm going to have a greater success of achieving than not achieving.
Exactly.
We're not going to go into correlations and tests of independence.
No, we won't go there. But so for example, you've got funds that have the different asset classes within them, or you have what's called single asset class funds. And what we normally say to clients is consider an appropriate mix of the multi-asset class funds and leave the asset allocation up to the fund manager. Because asset allocation is a full-time job, and it can get quite tricky at times. So if you look at your funds that are growth-orientated, so your multi-asset funds that are growth-orientated.
We're talking unit trusts now.
Unit trusts, you're looking at worldwide asset allocation flexible funds, South African asset allocation flexible funds, and South African asset allocation high equity funds, which are your balance funds. Now, if you look since inception, I've got data going back to September 96. The JSE did about 15.2% per annum. Okay,
and so that's an average, because sometimes it did 30, sometimes it did 2.
Exactly.
So because when we throw out those numbers, people say, well, it hasn't performed. No, relax. It's over a period, okay?
Exactly. So last year you got 2.5%, but the average has been 15.2.
Okay.
Worldwide asset allocation funds did 14.3.
Okay. That includes the offshore?
Including offshore.
Is that priced in dollars, or is that priced in rands?
This is all in rands.
Okay.
Your balance funds did about 13.8, and your South African flexible funds 13.5. So for growth investors, typically the JSE is your asset class of choice. But a lot of your multi-asset class funds were fairly close behind the JSE in terms of return. Look, you compound the difference over time, it can be meaningful. But when you consider that you achieved a very similar return with lower levels of volatility, the probability was likely that people would have stayed in those funds more than in the JSE. Because of the volatility of the JSE.
So Warren, tell me, how many people come knocking your doors? Yes, Warren, you shy balance fund, buddy. How many people are that clear and focused when they look?
No, I mean, I think they would arrive with an objective in mind. I want to save money for 10 years, and I want it for X. And it's then, you know, then it's a case of saying, okay, if that's your objective, let's understand your tolerance for risk. You know, can you deal with this money going up and down? And then let's choose a solution for you. Very few people, I mean, actually understand all the stuff that we're talking about. That's why we've got the show. Otherwise, you and I'd be sitting at home. And I think that's the point. Is you know, and I think you must stay out of the whole focus just on product the whole time. You know, in the investment world is really made up of a few basic things, and it's just mixing those ingredients in the right way and saying, okay, for me, because I'm 25 and I want to save for 20 years, I should have 75% of my money in shares. Great. Let me go and look for something that looks like that. Okay, great. This is a balanced fund. It's got that kind of a mix over time. Great. I'll look at that. And then you can shop around. But I think it's a real big mistake to start with saying, I want a balanced fund, because you actually might need a really low risk fund or really high risk fund.
Sure. Now, we have a bias on this show where our age group is perhaps that could join the ANC Youth League as an age. when you talk about a growth investor,
Yeah.
I imagine we're talking to our core constituency,
Sure.
somebody who is early on in their career and setting up for future. But not everybody's in that category. What if
Yeah.
some of us are 45?
Yeah.
What mindset do we have to have when it comes to doing these asset allocations?
Yeah, so there you're looking at a more conservative investor, somebody that perhaps puts a premium more on capital protection than capital growth. And, you know, we have to remember that we're dealing with people. And people, when you're dealing with people and their money, it can be quite an emotive thing.
Sure.
And so what you want to do there is look at funds that will give you that capital protection over time. And I have to stress that it's to protect against inflation, not against downside risk in the short term.
In other words, money going down.
In other words, yeah,
that's
money going
a
up.
huge differentiation there. That it's
Yeah.
inflation. And put it to me one more time. Why should we worry about inflation? It's a number that the government decides over there. It doesn't really affect me, does it?
It affects everybody.
Okay.
You know.
Why is inflation this boogeyman that we have to worry about?
Okay, inflation is simply rising prices. And if you've got R1 million today, it'll buy you X. If you have R1 million in 10 years' time, it'll buy you X divided by 2, probably. So it's important that your money, it's the purchasing power of your R1 million today. You've got to maintain that. So your guaranteed products and your money in a fixed deposit, you put in R1 million, you take the interest. 10 years' time or 5 years' time, you still got R1 million.
Yeah.
And so you're going to be able to buy less and less.
Okay, that's the best definition of inflation and why it's important to us. On the other side of this break, we're going to be finding out, okay, multi-asset investing. Why do we need it? How do we do it? What's the upside for us? We'll see you just now.